Macy's cutting its full-year profit outlook as tariffs and higher promotions hit the business. Still, the retailer topping first quarter expectations as it moves forward with its turnaround strategy. Joining us now, David Swartz, Morningstar's senior equity analyst. David, going into the report, I know that you had a $24 price target on the stock. I am curious, though. You say in one of the headlines of your recent notes that Macy's lacks competitive edge. Is the strategy to focus on successful stores going to be enough for Macy's, and how are you viewing the results now?
I do think that the stock is undervalued. As you mentioned, my fair value estimate is $24. So actually, I think it's trading at about half of what it's worth. But Macy's certainly is a troubled company, and that's reflected in the valuation right now. Macy's is in the process of closing a large number of stores, closed a lot last year, closing more this year, will close more next year, to focus on the stores that are performing better. Now, we're not really seeing positive comps from those stores, so it's certainly, at this point, uncertain that Macy's can really turn it around. But Macy's does have some things that are working. Bloomingdale's and Bluemercury are both performing much better than Macy's. They've both had consistent positive same-store sales growth. While some of the Macy's stores are performing okay, others are definitely dragging down the total numbers. And so I think at this point, Macy's is maybe not even halfway through its turnaround plan, and so it's hard to know if it's going to work in the long run. Should investors believe in this turnaround plan, Dave? I think at this point, the stock is so cheap that you don't necessarily have to believe in it to own the stock. I know that there's a lot of skepticism about the department store model. It's a model that doesn't work anymore realistically, and Macy's is dealing with a business that was built for a completely different retail environment, and Macy's is having to transform how it operates and having to downsize considerably to work in this market. And it's not clear that those actions will be enough to really turn it around. But I do think that there's value in Macy's, and that there's value in the stock right now, and that there is a place for Macy's in retail. This is a company that has a very large e-commerce business, for example. It doesn't get much credit for it because people still see this as largely a brick and mortar business, but Macy's does something like $7 billion a year in online sales. So Macy's does have a reason to exist, in my opinion. I think the stock is so cheap that it's worth looking at. As a digital first business, if they are able to make that transition, knowing that some of the elements of this turnaround plan mean, to your point, looking across the retail footprint that they do have, brick and mortar, and saying, okay, what's profitable, what's unprofitable, where do we need to shrink square footage size so we have less overhead that we have to account for? A lot of that sounds like a Sears playbook as they were in their peak slippage years. And so all of that considered and seeing exactly what took place, how is this essentially going to avoid being a similar case as Sears while they make that digital transformation? Well, one thing you could say is that Macy's still exists and Sears doesn't. So I guess you could say that Macy's did survive. And we have seen a lot of other department stores go under too, including Bon-Ton, for example, Lord & Taylor and Gordman's and others that have gone out of business in the last 10 years. And we're probably going to see more. I mean, for example, JCPenney probably doesn't really have a future. And so, Macy's, I think, does stand out. It does have a large number of private label brands that do very well. It does have a good selection of merchandise, and Macy's does reach a large number of consumers. It has a large customer base, has millions of credit card holders, and is still the anchor in a lot of malls. And so, I do think that Macy's can survive where others have disappeared. It's going to be a smaller company. Macy's will never get back to its peak revenues, which I think it hit about 10 years ago. So this is going to be a smaller company, but there are successful retailers that have far smaller revenue bases than Macy's does, and they maintain their profitability. I think Macy's can also be consistently profitable after it does this downsizing and these remodeling actions that it's making right now.
Let's talk about Dick's. In your notes, you mention, and given your star rating on the firm, I can tell that you have questions about the valuation. How does the Foot Locker acquisition impact how you're thinking about the valuation of Dick's going forward?
Yeah, it's hard to say because it's still early. The Foot Locker deal was just announced last week, and people are still trying to assess how it's going to impact Dick's in the short term and the long term. I was probably one of the few that actually thought that Dick's was quite overvalued when it was over $200 a share. I thought it was worth closer to 160. So when the stock fell after the Foot Locker deal, to me that was partly because Dick's stock was overvalued to begin with. I understand why Dick's stock where it was at such a high level, because Dick's has been performing extremely well in the last few years. The business has really transformed, and it's been outperforming everybody, certainly including Foot Locker. And so a lot of people are very unhappy that Dick's is combining with Foot Locker, which realistically is an inferior business. But I think that Dick's is buying it for a very fair price at about $2.5 billion for Foot Locker. This Foot Locker stock price has been way down, and so even though Dick's is paying a premium over where the stock had been trading, they're still, I think, buying it at a fair price at only about 6 times depressed EBITDA. And I think from Dick's management's perspective, they're able to buy Foot Locker here for a very attractive valuation.
All right, we are going to be watching closely as that deal looks to close. David, thanks so much. Appreciate it.